Greetings from 3 Edge Asset Management in Boston. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3 Edge, and I'm pleased to be joined here this afternoon by Steve Cucchiaro, President and Chief Investment Officer at 3 Edge Asset Management. Steve and I thought that after a day like today in the markets, it would make a lot of sense to reach out to clients and give them our perspective. So we are now officially in bear market territory, and so I know that you're a student of market history. What are some of the similarities or comparisons with other market downturns in your experience with what we've gone through in the last few weeks?
Well, to get a full view over time, I can say I've researched every bear market that's happened since the late 1800s. And this is right up there in terms of severity with some of the worst. I can think of studying the crash of 1929 that led into the Great Depression. I can think of the crash of 1987, which ended up very differently, but had some similar features where you have a market that falls very sharply in a very short amount of time.
So if we go back to mid-February, which now seems like a long time ago, the S&P 500 was reaching all-time highs. Again, it had been doing that over a period of time. So what has changed? Where are we now, less than a month later, that has caused such a dramatic turn in the market?
Well, a lot of people will blame the coronavirus, and that's been a big catalyst to cause the market to turn down. But what we've noticed and what we observed through our research is that back in middle of February, markets were seriously overvalued and investors were very complacent. We were in what some call a market melt-up phase, where people were buying and causing prices to go up far in advance of economic growth. And that got stretched to unprecedented territory, or certainly on a par with as high as it's ever been. So that's one reason why we got very defensive even before the coronavirus hit in a serious way. And that's helped us to manage risk on the way down. But the two catalysts are, number one, certainly the coronavirus, because there's going to be a sudden shock to both supply and demand in the economy. But secondly is the war in the oil market. Saudi Arabia tried to get all the oil producers to agree to produce less to be prepared for the slowdown in demand from the coronavirus. Russia refused to agree, and Saudi said, well, we'll teach you a lesson. We will raise the production instead of lower it and drive the price of the market down. Russia, in turn, thought, well, if the price goes down, that's going to hurt U.S. and the shale producers. So the price of oil plummeted in a very sharp way. The reason why that is bad is not just about the oil market, but because so many companies who produce oil have taken on a lot of debt. And once this debt is harder and harder to pay, that hurts the credit markets generally, and that contagion starts to spread throughout the credit markets. And we have a period where companies have taken on much more debt in relation to the size of their company or the size of the economy or the cash flow. And so we do worry about the credit markets seizing.
Right, so sort of double whammy there. You had the coronavirus and the spread of that outside of China, and then you had the situation with the oil price, which could cause serious problems in the credit markets. And that combination was not great. One thing that we saw today, early in the afternoon, as the market really was struggling, was the Federal Reserve announced that they are going to step in and add, I think it was upwards of $1.5 trillion.
Which is a huge, unprecedented.
So huge amount of liquidity going into the financial system. Will that help us? Will that get us out of this, you think?
So immediately when this news came out, the market gained sharply. From a very low point, it gained over 4% in almost a matter of minutes. It's a very sharp gain. Unfortunately, it was short-lived, and we ended up with the market that closed at new lows. So investors recognized that the Fed was coming to the rescue, and in the past that might have been enough to turn a market around. But with this market, there's so much pent-up demand to sell that it was short-lived. Now, one of the reasons is that so many investors, including certain hedge funds and other kinds of investors, took on so much risk that not only did they get fully invested in the market, but they used leverage.
Right.
And when either a corporation borrows money or when an investor borrows money to buy stocks, that's based on the collateral or the value of the stocks that they buy. So when that value comes down, they get a margin call.
Right.
And they have to reduce the amount of loans that they have, and they have to sell, and that selling causes more selling.
Yeah.
That price coming down causes more deleveraging, and we're in a powerful deleveraging cycle where it has potential to seize up the credit markets. That's why the Fed is focusing so strongly on providing liquidity to the credit markets to try to mitigate that. Also, I think the market is expecting a stronger response from the federal government,
right,
to come in with some serious fiscal help, because with the coronavirus, there will be businesses that will have an immediate decline in their cash flows. And why business-wise, they should remain healthy for a long time. Cash flow-wise, they can get insolvent in a hurry.
Right.
So I think we can expect to see some help there. Now, what I can also tell you, and this goes back to your first question, that while during a bear market you see some of the sharpest declines in history, ironically, some of the sharpest gains in the stock market have been not during bull markets, but ironically during bear markets, largely as a result of the government trying to come in and step in and help.
Which also speaks to the fact that it just makes it more and more difficult then to try to think that you can get out of the way and then back in to catch those. It's never going to happen.
That's right. So what we advocate is to have protection in place before the downturn happens, especially if markets are overvalued. And then recognize that with a defensive portfolio, you're going to have some exposure to equities, but much less than most. But you'll also have some exposure to assets that could do well when the equity market is doing badly. When the rebound comes, those hedges might not do so well, but the small amount of equities you have can help offset losses in the hedges and give you time to think, give you time to be logical, and to decide, is this just a very temporary relief rally, or is this the real thing? Something that we've been able to develop as a resource is a very large database of information, lots of mathematical relationships, lots of historical comparisons to help us be logical and decide when should we stand back and stay defensive, which we're doing right now, and when might the time come when other people are forced to sell at panic prices that make no sense, and we and our clients with a lot of dry powder, a lot of defensive positions can begin to slowly walk back into the market and take advantage of prices that might have gone to a very undervalued state. Often investors that do well over long periods of time are those that are not too greedy when things are good, that have defensive hedges in place. And then when people are panicking, getting out no matter what the price, have the resources and wherewithal not only to maintain their position and not have to be in that panicky mode because their risk is much less, but then be able to take advantage of those future prices that might be better. Most people have a hard time knowing when to sell, but even a harder time knowing when to buy.
Getting back in is even harder. So thank you for all that. Very, very helpful. One other thing I was thinking as the market closed today is that we've been doing this now for over 2 decades, and I'm thinking that it is really days like this where this is what days like these are when our clients are expecting us to really step up for them and to do things in a very unemotional way, in an analytical way, in a disciplined way. Can you comment a little bit more on that? I really got that strong feeling on a day like today.
That's right. And based on our past experience, we lived through the 2002 recession and market sell-off, which was very severe. We lived through the crisis, the financial crisis of 2008, which is very severe. And in the past, our defensiveness really paid. Our clients are very appreciative of that. They didn't have to panic at the low and sell when other people did. They could instead be well positioned to ride through that volatility and then do well on the other side. And we've been very committed, knowing that as the markets get more and more overvalued, at some point, hard to know when the catalyst will come, at some point that defensiveness and caution would be rewarded. And now we're seeing that.
Great, thank you. Thank you very much for taking the time, providing your insight. As always, we want our investors, our clients to know that we are here. Please feel free to reach out to us anytime with any questions or concerns that you may have. And thank you for listening. Thank you.
Thank you all.